Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent. Are you looking to add some new dividend stocks to your portfolio? Well, you've came to the right place. We're covering the 5 best dividend stocks going ex-dividend October 1st through the 5th, 2018. So I released this article over on Monday. I went over using Dividend.com and grabbed a bunch of stocks. These are the 5 best stocks going ex-dividend next week. So I have 5 stocks for you guys. Ticker symbol ABM. This is ABM Industries. They're a business services, in the services sector. We have ticker symbol SYY. This is Cisco Corp. They're a food wholesaler, also within the services sector. We have ticker symbol GNTX. This is Gentex Corp. They do auto parts that are consumer goods. We have JPM, which is of course JP Morgan Chase. They are a money central bank over in the financial sector. And then we have DGX, which is Quest Diagnostics, and they're in medical laboratories and research over within the healthcare sector. So those are the 5 stocks going ex-dividend next week. Now, I pulled all these stocks off Dividend.com. I screened these myself. What I like to screen my stocks for is having dividend yields over 1.5. That means I'm starting off at a good yield. If I put in $100 into a stock, I'm going to get $1.50 in dividends, plus I'll get capital appreciation. More than likely, out of the majority of these stocks have good financials going for them. It's up to you guys to kind of screen them a little bit further and decide whether they are right for your portfolio. All of these stocks have had rising revenue, net income, free cash flow positive over the last 10 years. Also, their forward PE ratio, their price earnings ratio, is expected to decrease, meaning that their earnings are expected to increase next year, and they're expected to become more profitable, grow their earnings. And also, all of these stocks have grown their dividends for the 5+ years. 2 of them have actually paid out dividends and grown their dividends for more than 20 some years. So we're going to be covering those here in today's video. And if you are brand new to the channel, hit the subscribe button. If you do like this video, hit the thumbs up button. I highly appreciate it. If you have any comments, suggestions, let me know in the comment section below. And of course, we're going to be covering dividend dates, price comparison to the yield, PE comparison to the industry and the S&P 500, the payout ratio of each specific stock, dividend history, and a few other items. So if you're brand new getting started in your investment journey, check out M1 Finance or Robinhood. I have videos and playlists on both of those and use them both myself. So if you haven't checked them out, check them out. So these stocks are ordered by ex-dividends between October 1st and October 5th, 2018. So having number 1 just means that they're coming up ex-dividend first. So ticker symbol ABM Industries provides janitorial, parking, security, engineering, and lighting services for commercial, industrial, institutional, and retail facilities in the United States, British Columbia, and Canada. So they're not only national, they have a little bit of international to them. This stock is going ex-dividend on the 3rd of October, which is next Wednesday. You would have to buy this stock on Tuesday or prior in order to capture that ex-dividend, and then you would get paid out on the 5th of November. Here is the 10-year chart. So all you have to do on these graphs here is you can see the data as far as just trending very slowly over the past 10 years, moving positive. You can see here recently, as of 2017, there was a dip here within their free cash flow. Maybe they took on some extra, maybe they made an acquisition of some sorts. That would be something to research a little bit further. Their net income dipped there a little bit. Their free cash flow dipped there a little bit. Maybe they had to use some of their reserves in order to overcome some sort of an issue that they had. But for the most part, over the past 10 years, this company has moved up positively in their dividend, their price, revenue, free cash flow, and net income. If you take the 10-year average and divide it by 10, that's going to give you your return per year on average. So for example, their price in the orange is up 83% over the past 10 years. If you were to divide that by 10, that would give you an average return of 8.3% appreciation, plus you get a dividend yield paid out to you of around 2%. So you would actually make 10% on your return when you're adding the average return on, with that dividend yield. Here is the 1-year chart here. At the top, they pay out 17 cents, and a half a cent there per share each quarter. They're currently priced at $33.22 when I pull this information. That gives them a yield of around 2.09, 2.11 currently. Their current PE ratio is at a 26.16, which is pretty high, but if you look at their forward PE, it's expected to drop all the way down to 17.8. Their price to book is sitting at a 1.5, which is very healthy, and their price to sales is at a 0.34. So this would need a little bit of research. Some companies can show a negative, or not a negative, but like a low price to sales ratio due to debt that they've been taking on. So this would just be a little bit of a research item there. Again, ABM, they were in the business services sector. So when looking at the chart here above, it does show the current stock is currently trading with a yield over the price for the year, which may indicate it may be undervalued at this time. The stock is at the industry average, so the stock is right around a 26.16. It's actually slightly below. When I pulled this information off Morningstar and then this actual information off here, it is slightly trading below the industry average, but slightly above the S&P 500 average. But if you look at that forward PE at 17.8, that puts it well below the industry and the S&P 500 average. The payout ratio for this company is 37.2, which is below the 60% payout ratio, so their earnings could drop by half. Their payout ratio may increase to around 60-70%, but this company could continue to pay out during downturns and raise their dividend, as they have done so for the past 50 years. This price to book is at 1.5, which is below 3.0, where value investors would consider it a value. So this puts it at a pretty good value play. You're getting a high yield on cost for your current buy-in, good solid financials, good history of dividend growth. Number 2, on our ex-dividend, we have ticker symbol SYY. This is Cisco. It's one of the world's largest broadline food distributor. The company focuses on marketing and distributing food products to restaurants, healthcare, and educational facilities, hotels, and inns. You've probably seen their trucks on the freeway or just delivering food service to so many of the other businesses out there. So they serve over 400,000 clients. This company is going ex-dividend on the 4th of October, which is next Thursday. You'd have to buy this one on Wednesday or prior, hold it until the ex-dividend date, and then be able to capture that payout on the 26th of October. You can see this one over the most part here. Their free cash flow had dipped after the recession, but has came back up positive coming out. Over the past 10 years, they have finally, the free cash flow is up 9.77%. So they did have a bit of a dip here during that downturn and have slightly recovered out of there. So this company is up 134% over the past 10 years. That puts them at an average return of 13.4%, just based on appreciation. They also have a payout of 1.93% right now. So we'll estimate that this company pays out roughly 2% of their share price per year, on top of that 13% appreciation for the company. So that gives them about an average return of 15%, give or take. Also, you can see all their other numbers here. Dividend price change up 6.3% on average per year. It's a little bit, I like to look for stocks that have a 7% increase on average per year for dividend change. In the red, their revenue. In the purple, their net income. And in the green, of course, is their free cash flow. Here, we're looking at their 1-year graph. They currently pay out 36 cents per share each quarter, currently priced at $72.96. That gives them a current yield of around 1.93, 1.97, depending on the day. Their current PE ratio is at a 26.92. Forward PE is at a 20.82. Price to book is very high at a 15.3, and their price to sales is at a 0.657. So when charted, it does show the current stock does have a price over yield, which may indicate at this time it may be overvalued or just kind of overbought. Stock is trading above the industry average of 22.3. Again, the industry that it's in is food wholesale, and it's also trading above the S&P 500 PE average there of 25.3. The payout is actually below 60%. It's sitting at a 41.3% payout ratio and has been increasing their dividends for the past 47 years. So again, another very recession-proof stock here. During downturns, they will continue to pay out dividends, and maybe that's what happened here. They had to dip into their free cash flow, paying out those dividends during hard times, but they maintain their dividend payout and helped out their shareholders. So price to book value on this one is at a 15.3, which is very high in comparison to the 3.0 average, where value investors would consider it a value. Again, this stock is traded at around a 1.97 yield. They pay out $1.44 per share for the entire year per share. Yep. Payout ratio is at a 41.3, and they've had dividend growth for the past 47 years. Number 3, GNTX, Gentex Corp. They design, develop, manufacture, and market electro-optic products, including automatic dimming, rear view mirrors for the automotive industry, and fire protection products for the commercial buildings industry worldwide. They're also going ex-dividend next Thursday on the 4th of October. You'd have to buy them on Wednesday or prior, hold them until Thursday. The payout date on this one would be the 17th of October, so pretty quick return on this one. You can see this one does have some very high numbers as far as movement goes, whereas the other ones may have been in the single digits for the past 10 years on average. This one, their dividend change on average is up 10% a year on average. So that's their lowest financial metric. If we take a look at their price here in the orange, their price is up 27.6% on average per year. And the red is the revenue up 19.1% on average per year. The free cash flow for, 47% on average per year. And in the purple here at the top, their net income is up 61% on average year over year. So very good growth out of this company. So looks pretty good. This is a good one here. I would check out a little bit further just due to that dividend. I like to have dividend stocks. I'm just going to go ahead and just report on these ones, and we can kind of discuss what I believe, my opinion at the end. So here, Gentex, when charted, does show the current stock does have a higher yield over price. I say yield over price because the current dividend yield is 1.97. This chart does not show that they currently increased their dividend from around, 10 cents per share to 11 cents per share. That was a nice, 10% dividend hike there. That puts them at a new yield of around 1.97, 2%, depending on the day, which is above that price of $22.35. Their current PE ratio is 14.33, forward PE is 13.4, price to sales is at a 3.45, and price to book is at a 3.12. So again, yield over price currently, saying it may be undervalued at this time or kind of at that valued opportunity buy. The stock is trading above the industry average of 13.7. The industry for this one is automotive parts. They develop rear view mirrors and all sorts of little electronics. And they are below the S&P 500 average of 25.3 currently. They are trading below 6% payout ratio. They're only trading out payout of 26.5, which is way below that half point at 50%, and they've had dividend growth for the past 7 years. I forgot if this company locked their dividend. I believe they locked it out. They didn't cut it. I believe they had locked it during the downturn, or that they just recently started paying out dividends. So price to book on this one is at a 3.12, which is slightly above that 3.0 value, or value investors would consider it a value. But if you look at your stocks that you may be holding some stocks that do have a price to book value higher than 3. So this may not be a metric that you used to, base stocks off of. So again, PE currently sitting at a 4.3, forward PE is at a 13.4, which does put them below the industry and the S&P 500 average there. Dividend yields around 2%, 44 cents payout per share, because they just recently increased their payout to 11 cents per share each quarter, and they've grown their dividend 7 years. Number 4, everyone's favorite financial bank there, JP Morgan. They're a multinational bank and financial service company. They provide the investment banking, financial services for consumer and small businesses, commercial banking, and yada, yada, yada. They do a lot of banking, one of the largest banks in the United States in terms of assets. Just about everyone I know, does their banking at Chase. If they're in the civilian sector, if they're in the military in the past, they probably used USAA. But for the most part, I know a lot of people that use Chase. So this one's going ex-dividend again on Thursday, the 4th of October. You'd have to buy this one on Wednesday or prior. You would then get paid out on the 31st of October. We can see here over the past 10 years, this one does have some negative free cash flow. It's one of those financials. So negative free cash flow, you can see it varies. It goes up, it goes down, it goes up, it goes down. Currently, financials have been getting hammered here recently with rising rates. That should really help them out, making their loans payback, more profitable for them. But This is one I included in here because this actually did a little bit slightly better than some of the other ones on the list this week, so this one just made the cut. So here in the purple, net income up 39% on average per year. In the orange, price is up 13.4% on average per year. You can see it's pretty flat going to 2018 as we have raised rates 3 times now. Going, Wednesday we're going to be raising rates again, we believe. Dividend recently got a huge hike, which really helped them out. They did cut their dividend back in the past, but since 2011 they have increased their dividend, which puts them over that 5-year point. But with this huge hike here, once they dropped the barriers on them, there was some change recently that allowed them to pay out and not have to have so much money on books. They increased their dividend by by 40 some percent, I believe, and that really put them over that percent there. And in the red, they have their revenue up 5.6% on average per year. Free cash flow is down there slightly. So here, for the year, they increased their dividend from around 55 cents per share each quarter to 80 cents per share each quarter. They're currently priced at $116.80. That gives them a yield right now. They just increased their yield. This doesn't show the current yield. This shows 1.92. Their actual yield is 2.24. You can get this by taking their current payout, which is 80 cents per share. You multiply that by 4. You divide that by the current stock price, which is $116.08. Multiply that by 100, and you get that current dividend yield of 2.73%. Yep, right on the dot. Okay, and let's see here. Price to PE ratio is currently at a 15.55. Forward PE is at around a 12.65. Price to sales is at a 3.88, and price to book is at a 1.69. So when charted, it does show the stock does have a higher price to yield currently. No, it doesn't. So the actual yield is over the price right now. The yield's up here in that 2.7% range due to that huge increase that they recently did, putting them at a slightly value buy. I know a couple of their investors on YouTube and also in the Facebook groups have been checking out financials as they've been kind of hammered lately. If you had bought Goldman Sachs, JP Morgan, a few others here back in that February dip, you would have got a pretty good buying opportunity there. So the stock is trading slightly below the industry average and the S&P 500 average there. It's currently at a 15.55. Industry is 17.9. S&P is at a 25.3. This company does have a low payout ratio of 35%. I'm not sure if this is including the new dividend increase that they've recently paid out. That would be something interesting. I have to check out their earnings and see how much of it they pay out. Dividend growth for the past 7 years coming out of the recession. Their price to book is at a 1.69, right around that 1.5 level. This, for financials, you're looking at a price to book between anywhere between 1.7 and below. I would say it's a pretty good buy for any sort of financial as far as price to book goes. Here, stock, we've already covered most of this information here. So annualized payout, if you were to multiply their current payout of 80 cents per share by 4, that puts them at a $3.20 per share payout. That's a pretty good payout there. Number 5, our last stock this week is ticker symbol DGX. This is Quest Diagnostics. They provide diagnostic testing information and services in the United States. The company offers routine tests, including blood labs, blood cholesterol levels, complete blood cell count, urinalysis, pregnancy and other pretermal tests, alcohol and other substance abuse tests, and allergy tests. So again, this stock's going ex-dividend next Thursday on the 4th of October. You'd have to buy them on Wednesday or prior. You would then get paid out on the 22nd of October. Here you can see this company has raised their dividend by a very large amount, 40% on average per year. You can see some huge rate hikes, dividend hikes. 2013, huge one there. So this one has, 40%. Is that maintainable? Probably not. But price has increased on average 10.8%. In the purple, net income up 3.9% on average per year. In the red, we have the revenue at 0.5% on average per year, and the free cash flow at 0.4% on average per year. So pretty 0.04, 0.05 there on those numbers because you're multiplying it or divided it by 10. Oh, it's only one decimal, so I was right the first time. But still, Interesting company there. Here, 1 year graph. Let's see here. They pay out 50 cents per share each year or each quarter per share. They're currently priced at $107.61. Dividend yield is currently a 1.86 because they recently did increase their dividend from around 44 cents and some change to now 50 cents there. A very nice rate hike. Their current PE ratio is at a 18.52. Forward PE is at a 16.3. Price to book is at a 2.8. Price to sales at a 1.9. This one overall looks one of the most valued stocks in terms of metrics go here. So when charted, it does show the current stock does have a higher yield over price currently, which may indicate it may be an undervalued or valued stock at this time. The stock is trading below the industry average of 41.4. The industry for this one is medical laboratories and research and healthcare, sort of within that. Procter and Gamble, Johnson and Johnson, and a few others there. S&P 500 PE is at a 25.3. This one again, dividend yield currently sits around a 1.86 because of that new change in dividend. They pay out $2 per share each year. The current payout is at a low 30.4, and they've had dividend growth for 6 years. So out of all these companies here, we have 5 stocks again. Starting at the top, ticker symbol is ABM, which is ABM Industries. They're in the services, business services sector. We have ticker symbol SYY. This is Cisco. They're in the food wholesaling, again, services sector. We have GNTX, which is Gentex Corp. They're in the automotive parts and consumer goods sector. We have ticker symbol JPM, which is JP Morgan Chase. They're in the money central banks and financial sector. And we have ticker symbol DGX, which is Quest Diagnostics, and they're in the medical laboratories and the healthcare sector. So when taking a quick look over these, I believe that the best current valued one would be between GNTX and DGX, I believe. I forgot to see what the other ones were. I know over on my Facebook page, your ABM actually look at a pretty good, if you're looking at dividend growth over the long term, I think that ABM is probably your best bet as far as a dividend growth investor, but I would want to research why they took such a huge dip here in their free cash flow and in their net income. What happened at the end of 2017 that took a large chunk out of there? It looks like they did recover it, but that would be interesting to go over their 10K. Their annual report and boy, I cannot think right now. Their yearly report and kind of see what the heck happened there. So dividend growth investor, ABM would probably be my first pick. Now, as far as my second pick, that would be something more along the lines of GNTX or DGX to kind of check those out a little bit further. But those are very short term. This one here doesn't look like it has very strong financials as far as price is the only thing that's really moved up in the double digits over the past 10 years. Quest Diagnostics only up 3.9% on average for their net income. So I would say that the second pick would probably end up being Gentex, ticker symbol GNTX. So between ABM and GNTX for this week. But check all 5 of those stocks out. Let me know in the comment section. But let me know in the comment section below. Out of these 5 stocks, which one would you feel, which one of these would you want to investigate just a little bit further and check out for yourself? And let me know in the comment section below. I'd highly appreciate that. So that is it for this video. If you guys did enjoy the video and watch it up until this point, hit that like button below. I really appreciate it. If you're brand new to the channel, remember to subscribe for future financial videos. If you have any questions at all, want to say hello, leave me a comment below and I will always reply. And if you haven't visited my Facebook group, go ahead and check that out, also in the description below. As a friendly disclaimer, I am not a financial advisor or tax professional. The information provided in these videos is for entertainment and fun. This is not investment advice. This is just me as a financial investor myself, trying to help others make their money work for them. Look for some deals out there. I think that there are some good buying opportunities out there, especially right now where the markets are. Some stocks are actually trading near 52-week lows. So if you're able to buy them right now, they won't have for the most part, shouldn't have too much of a downturn in the future, as they've already been in that downturn currently, and they'll have much more upside than downside potential. So that's it for this video. Thank you guys for tuning in. I will see you next time. Have a great day. Bye.